Whenever we talk about gold, we also talk about how to study history. And gold has historically been valued at 10 to 20 times the price of silver. You also had periods where you have great discrepancies. You had periods between Asia and Europe where it was 1 to 5 one place and 1 to 15 the other. So it's a fascinating story in itself, but it's the very opposite of high frequency trading. You literally have people like traveling through continents to make that 3 to 1, from 1 to 5 to 1 to 15 arbitrage. And yet the principles of that, stayed the same. And they could do that because of all the risk that was involved, and also because of basically just the time they were in. But regardless, the ratio has always seemed to revert to that 1 to 10 or 1 to 20. And you have detailed information from Greece, Rome, Japan, China, the Middle East, and it always seems to go more or less back to that. The US followed Alexander Hamilton's advice and set the gold to silver ratio to 15 to 1 in 1792 with the Coinage Act. So having known all that, it might be surprising if you look into the gold to silver ratio today. Silver is about 19 times as abundant as gold in the Earth crust. Only has 8 times the output, which is, of course, is also a function of demand supply here. But then you consider that gold is currently valued at around 80 times the price of silver. So this is my long-winded way of saying, could you please, Lyn, pin some color around the gold to silver ratio and why it's so different today than it has historically been?
Yeah, as you point out, we have pretty good data stretching back on multiple continents, thousands of years. And that, it varied, but that 10 to 20 ratio tended to be the norm. And silver, is like the commodity with the second highest stock to flow ratio, right? So gold is over 50 at the current time. So we have 50 years of annual production estimated to be stored up in our vaults. Silver is lower. There's different estimates, somewhere between, say, 10 and 30 stock to flow ratio, probably around 20 or so. Whereas most commodities, a lot of them aren't even above 1, right? So there's a big gap between gold, silver, and everything else, including things like platinum. Even though platinum is super rare and other platinum group metals, because they're so heavily used in industry, they actually end up having low stock to flow ratios despite being very rare elements. And so historically, over most of that period, gold was the harder money in the sense that it's rarer, higher stock to flow ratio, more desirable, more identifiable, but the big caveat that it was not as divisible, because even a small gold coin was like a full week of labor for like a worker, whereas silver was like the second best commodity in most metrics as money, but it had more divisibility because the units just happened to be like the right amount of value for daily transactions. And sometimes you'd have to go down to copper pieces when you really wanted the smaller transactions, but silver was kind of the sweet spot in terms of being a monetary asset while also having reasonable divisibility. And so there's different thoughts on why silver got partially demonetized over time. So when you start to have it be more set formally, the problem that maintaining a bimetallic standard is that you run into Gresham's law. And so, for example, the global price of gold and silver at the time of the 1700s, 1800s was like 15.5 to 1. And so if the United States set it to 15 to 1, basically it's making silver be overvalued. And so what happens is like the global market can come in and arbitrage that. And you basically, whatever metal ends up being overvalued ends up going out of circulation. It gets kind of pulled out of your country. It gets arbitraged away, either hoarded in the country or it gets arbitraged out of your country. And then what they did is they flipped it. They said, okay, no, we're going to make it 16 to 1. And then the other metal got arbitraged out. And so even though it actually doesn't seem like that big of a thing, over the course of years and years and years, these arbitrators just keep leaking whatever gold, whatever metals overvalued away. So it's actually pretty hard to maintain a bimetallic standard because there's no exact ratio that's like, quote unquote, the correct ratio. It's kind of just based on market conditions. Now, there are some economists that theorize on why silver eventually encountered a far more weaker ratio over the past, say, 150 years. And so I think in my view, the most convincing argument is that when we created paper money, and especially like modern telecommunication systems where you invented the phone, so you could deposit money in a bank and have that show up in another bank across the world, just because it's all bank ledgers that are just agreeing on how these numbers are going to settle, you suddenly made gold far more divisible. right? Because you had gold-backed paper money. The money was more divisible than silver in terms of the units it could be broken up into. And so silver over time became less useful because gold fixed its one weakness, which was divisibility. And so you started to get basically evidence of demonetization of silver. And so that ratio started to flip. If you look at earlier parts in history, there were other times where other commodities were used as money. Things like feathers and shells and beads and certain types of stones. And the problem is that when they encountered a harder money, like another civilization would come with better technology and they'd have gold and silver, and that technology could, that culture could come and make more feathers, find more feathers and get more shells, and they had better technology to do it. They could basically break the stock to flow ratio of that other culture's weaker money. And so you've always had this kind of history of, different commodity monies beating out other ones. And gold and silver have that survivor bias of they're the ones that beat everything else for thousands of years. And you can argue that eventually gold beat silver with the invention of modern banking, and that the fiat currency kind of beat gold because its other big shortcoming is that it's, as we talked about, it's easy to centralize and then rehypothecate and kind of make multiple claims per ounce. And so now we've encountered that new environment. But I would say that I wouldn't necessarily rely on the gold to silver ratio going back to where it was before. That's not to say it won't, but I don't think there's no sort of law of nature that it has to. And I think there's a compelling argument that things have changed enough that ratio is now kind of structurally different. But I still think that in the grand scheme of things of thousands of years of history, 100 or 150 years is still kind of ironically not a huge sample size to work with.
It's interesting you would say that, Lyn, because I feel the exact same way. Whenever you do study history, you would think, yeah, that it makes sense why it would be around 15 and why in some societies might be 10 or 20. If you look at the situation today, it would make no sense why it would revert back to that ratio. It just wouldn't, the way we structure the system here today. I just wanted to give a shout out to a book called The Power of Gold. I can highly recommend it if people want to read it. It's if you want to, I could just teasingly say that if you want to phrase yourself in like 140 or 280 characters, this is not the book for you. It might be on the more intellectual side that can be a bit dull to some. But if you're really into like the Coordinates Act or what Marco Polo saw whenever he served under Kublai Khan and silk and silver backed standard and how that worked, if you're really like into history and the history of money in the light of gold. So let's continue talking even more about gold. People can probably tell that I start to get excited here. Many investors have historically argued for buying gold stocks rather than gold itself. And you could say it makes sense because the best gold stocks outperform physical gold over the long run because they're short dollars and long gold, and gold has historically performed better than the dollar. On the other hand, many gold stocks underperform the market price of gold because they have a destructive capital allocation. Could you please paint some color around whether gold bullion or gold stocks are most appealing?
Going back to our prior question of whether or not it's good to have a permanent allocation to some of these commodities, so I think that you can make a much stronger case to having a permanent gold allocation, or let's say gold and Bitcoin, whereas it's much harder to make an argument that you should have a permanent gold stock allocation. And that's because unlike gold that over the long run kind of keeps up with money supply growth and does what it's supposed to do, gold stocks, as you pointed out, have this destructive capital element. And basically, one is that mining is already a hard business. You don't control the price of your own product. You have a lot of hard capital expenditures. You're often working in jurisdictions around the world that are emerging markets, right? So you're managing these different jurisdictional risks. You face, at the extreme end, you face nationalization. Your countries can just take your mines from you, or they can change their tax policies. You're dealing with usually more problematic infrastructure, less developed infrastructure. And so it's a challenging business to be in. So there's more things that can go wrong that can go right to start with. Two, if you have an inflationary period, some of those gold miners, I mean, they use a lot of energy as an input, right? So they have all of their machines are using fossil fuels. The gigantic tires on their machines, you don't even think about it, but the amount that they spend on tires for these like huge dump trucks that are like the size, like the tires are like the size of a car. Those are mostly made out of fossil fuels, and So when you get like a inflationary period of energy prices going up, it can actually squeeze the margins of gold miners, especially if gold's not, yet keeping up with the price of energy, or sometimes even if it is. And then two, you have managerial mistakes. So, during very highly valued gold environments, there's usually a lot of euphoria in the space. There's a lot of new capital coming in, and managers tend to overpay when they do acquisitions. So they'll take on debt and they'll buy a company, a smaller mining company. And then the problem is that the price of gold goes down, as it did say after 2010, 2011. It turns out you took on too much debt and you overpaid for this asset. And then so now you're channeling money into trying to pay off your debt. You might even have to sell your asset, divest it to raise capital, and now you're selling at a much lower price because gold's a lower price. And so you generally have this kind of pro-cyclical, non-contrarian investment cycle that destroys capital. Now, really, really good gold company CEOs are counter-cyclical, very disciplined with their expenditures, very selective with their acquisitions. They basically are very good at allocating capital and unlocking value. And so the best gold stocks over the long run outperform gold, whereas the majority of gold stocks ironically underperform gold, which is like basically imagine being an industry where like most of you destroy capital. That's really what happens in that space. And that's generally true for a lot of commodity industries. Oil's been somewhat an exception because of the OPEC and the cartel-like aspect of that industry that has smoothed that out compared to many other commodity industries. But basically, it's just a very challenging environment. And so there's a much weaker case for owning gold stocks long term. There are some business models like royalty and streaming companies. They are financiers of gold miners. And so they have less operational risk. They usually have, break-even prices that are much, much lower than gold miners. And so they're kind of the exception where they've been able to compound capital in a way that most miners do not. And so I think gold and streaming companies can be a long-term hold, but for most gold and silver miners, you have to be very selective with them and only hold them in environments where you expect gold and silver to do pretty well. Otherwise, you're just destroying capital. So I think that's more of like you don't marry those positions. You might invest in them for 1, 2, 3, maybe even 5 years if you're very bullish on it on this part of the decade. But I wouldn't say have a permanent allocation to gold miners in the way that I would consider a permanent allocation to gold itself.